Moody's, the rating agency, has done historical data which shows that losses in infrastructure are less than half of what you see on comparable corporate lending over a really long period of time. So you get that stability because you're lending money, credit losses are low, and it's also because it's infrastructure, which is a very low risk asset class.
Hello, you're watching Proactive. I'm joined by SIMCo Head of Portfolio Management, Steve Cook. Steve, very good to speak with you. For investors who are new to this story, what is the Sequoia Economic Infrastructure Fund and what role can it play in a diversified portfolio?
Yeah, thanks, Stephen. First of all, we call it always SEQI because the full name is the Sequoia Economic Infrastructure Income Fund, which is such a mouthful. We like to keep it short, and the ticker is SEQI. So, first of all, what is the fund? Well, it's actually very simple. What we do is we make loans to infrastructure companies and projects around the world in developed markets. We have a diversified portfolio of these loans, which generates a good, strong, steady income and has a stable net asset value. And we get that stability because, first of all, we're lending money, so we're not taking all the risks of ownership. And secondly, infrastructure in and of itself is a stable, defensive, asset-backed asset class with high barriers to entry. So it fits very well into portfolios that are looking to generate yield. And it has an added benefit in that historically infrastructure has had a low correlation to other asset classes. And all that means is that when you see periods of extreme turbulence, so think about geopolitical events or COVID or severe recession, infrastructure tends to outperform the broader markets. So as well as adding income to a portfolio, you're also adding stability to the portfolio.
Steve, your objective is to deliver both a high level of income and also capital preservation. How do you achieve that through private infrastructure debt?
Yeah, and I think it's a very good question. First of all, I think capital preservation is naturally achieved through debt and fixed income products, right? For the very simple reason that obviously if you lend £1, you will over time collect interest and then get the pound back, right? So absent any bad debts, you're naturally preserving your capital. Now you may say, well, what about credit risk? What about the risk of bad debts? And the answer is that in any credit strategy, clearly that is a risk, but infrastructure is one of the very lowest risk sectors in the whole of credit investing. In fact, Moody's, the rating agency, has done historical data which shows that losses in infrastructure are less than half of what you see on comparable corporate lending over a really long period of time. So you get that stability because you're lending money, credit losses are low, and it's also because it's infrastructure, which is a very low risk asset class.
Well, I think you've partially answered this, but what makes infrastructure debt different from corporate bonds or equity investing, Steve?
Yeah, so in regards to corporate bonds, partly it's the fact it's infrastructure, as I mentioned, but there's another very interesting dynamic, which is if you look in the general corporate credit markets, so things like corporate bonds, high yield bonds, leverage loans, they are awash with capital, right? There's been a tremendous amount of capital gone into those. In fact, the way that manifests itself is the credit spreads, so the margin that lenders make, are currently in the 10th percentile of all-time expensive spreads. And some markets are in the first percentile. So in other words, they're more expensive now than they've been 99% of the time historically. That's general corporate credit. However, infrastructure is very different because the supply-demand imbalance is there, right? So if you think about the world, we need tremendous amounts of capital for digitalization, for power, going into things like data centers, decarbonization, demographic changes. A lot of geopolitical stuff is changing globalization trends, for example. That requires a massive amount of capital, and historically, governments have financed a lot of that. Nowadays, governments can't afford to finance it, right? So increasingly, a lot of infrastructure is getting funded in the private market, and there's just not enough capital. So compared to the general corporate markets, right, where there's more capital, right, there's more supply than demand. In infrastructure, there's more demand than supply. And you don't need to be an economist to know that's going to give you very good risk-adjusted returns if you have got purchasing power and the ability to selectively deploy capital into the most attractive parts of the market.
Steve, the SEQI portfolio spans more than 50 investments across multiple sectors and geographies. How does that diversification help protect investors?
Yeah, so it's tremendously valuable in fixed income investing to have a diversified portfolio. And the reason is and it's very simple, you're spreading your risks, right? You're not putting all your eggs into one basket. But in infrastructure, there's an added benefit in that you have typically in infrastructure a very low correlation to the general economy, right? We talked about how stable a lot of infrastructure assets are over the economic cycle. And that means your portfolio doesn't move, as it were, in one direction. If you have a recession, for example, or something like COVID or an energy price shock, you find different parts of the infrastructure market respond very differently. So, for example, when energy prices go up, that tends to be negative for transportation, but positive for electricity generation. By diversifying your portfolio, you're getting therefore a range of responses in different economic situations, and that adds tremendously to the stability of the portfolio.
How does today's global macro environment affect the opportunities you're seeing and the returns you expect?
Yeah, I think it's actually a really interesting time to invest in infrastructure debt. First of all, interest rates are quite high, right? And that helps to support a very high dividend yield on the portfolio. Secondly, it seems unlikely that interest rates are going to fall very rapidly in the very short term, given all the inflationary pressures arising from oil prices and elsewhere in the world. Thirdly, as I mentioned, there's a shortage of capital, right? And that's got actually two consequences. One is we're getting very good returns on the loans that we make because, we've got pricing power. But secondly, it also means we can be very selective, right? So we reject over 90% of the potential investment opportunities that we see. To put that another way, we pick the best 10%. So we're in a position now where I think the interest rate environment is favorable, the supply-demand dynamics are favorable, and the credit selection is very good because we're able to say no to 90% of the deals that we look at.
Steve, the fund currently trading at a discount to NAV while offering a dividend yield of more than 8%. Why do you think now's an attractive time for investors to take a fresh look at SEQI?
I think what we've seen over the last few months, and possibly over a slightly longer period, is in the sector discounts beginning to narrow, right? And I think that's partly a reflection of additional capital coming into the asset class. It's also partly a reflection of a number of funds in the alternative sector going private or unwinding or otherwise leaving the market. And again, actually, it's often down to supply and demand dynamics. But I think in today's interest rate environment, income generating funds are always going to be attractive, and there's a diminishing number of them and an increasing demand for them.
Steve, thank you very much for joining us today. Very interesting to hear about the portfolio.
My pleasure. Thank you for having me.
Steve Cook, the head of portfolio management at SIMCo.